Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, June 3rd, just after the close. This week, some good, some bad. Probably doesn't feel like it on a weak Friday, but the markets broadly finished up for the week. S&P, let's call it up 1.25%. That's important because coming off of last week's strength in the S&P and the NASDAQ, and really across the board, small and mid cap, the one thing you didn't want to see this week was a give back. You know, we've seen an awful lot of that. We've had big rallies in February, in March, in April, and they only stuck around for a couple of days, and the selling was intense after those moves. A little different feel to the tape this week. Yeah, there was some selling on Tuesday and Wednesday, but it was contained. There was buyers that came in the afternoon, and we stayed well above the lows of, call it 6 or 7 days ago. Important information. The market's always trying to share information with us. And what it's telling us right now is you do have new buyers in the market at levels above where we were a month ago. Very important. The one area that is still a concern is oil. We've talked about the three things that have to go right to take some pressure off the market longer term. The first thing is interest rates have to be contained. Pretty much they have been. I know off the report today, the employment report, you got a bump in yields. I think the 10-year closed around 295, so that's about 10 basis points or 0.1% above last Friday. That's okay. If we can stay in that 275 to 310, 320, I'll take that. The dollar backed off a little bit last week and didn't retrace the up move this week. Why is that important? Well, you heard Microsoft this week say business is fantastic, but that strong dollar is hurting our profits. And we've been talking about this for a couple of months now. That strong dollar is a problem for our U.S. companies in terms of their profit margins. Be nice to see that dollar come down a little more. It came off its highs. Now we need it to continue to weaken. The third piece of the puzzle is oil, and that's a problem. At $119, $120 a barrel in West Texas crude, that is a tax on the economy. That's a tax on our public companies, tax on our private companies, tax on individuals. So be interesting to see if something can help in terms of supply there. Again, we have that bottleneck in terms of creating the distillates, creating the gas from the oil. Real bottleneck. Valero, Marathon, those are some names to look at that I'll be looking at. In terms of what we have set up for next week, we're going to see if some of that tech move that we started to view and identify 5-10 days ago can continue. Semiconductors have traded very well. They're a tell for us. Semis are a tell on the growth side. Traded very well. Even some of this midweek weakness and weakness today, they're well above where they were 10 days ago. Be important to keep track of them next week. In terms of fixed income, we are going to shoot it over to John Mousseau, who's going to focus on today's employment report and what that may mean to rates going forward. Take it away, John.
Good afternoon. It's John Mousseau. I am the CEO, Director of Fixed Income at Cumberland Advisors. It is Friday afternoon, June 3rd. This week in the bond market, we saw yields rise, really taking away a little bit from last week. We saw the 10-year bond rise about 20 basis points, 30-year bond rise about, call it, 15 basis points or so. And, basically to a 293 and above 3% on the 30-year. Really, that's backing and filling. We're still well below the 320-ish range where we were on the 10-year bond early in May. I think what you look at today is you look at something like the jobs number, which came in stronger than expected. They were talking about jobs at 318, came in at 390. More importantly, I think, though, is if you take it as a whole, you look down, the job growth was still less than last month, which was around 420-ish or so. And, the reaction to it is that, yes, yield's a little bit higher, but you're kind of in this range where people think maybe the Fed can get their job done by continuing to raise short-term interest rates. Some signs there. The job participation rate, labor participation rate, a little bit higher by 1/10. That tells you more people are starting to look for work. Unemployment was expected to be 3.5. It was 3.6. Another sign of stability, that maybe people are back out looking for work. Because remember, in the unemployment stats, if you are not working but not looking for work, you don't count. More people looking for work. All of this is a healthy sign. Stock markets. My colleague Matt talks about that. Took a little bit on the chin today. But we think in bonds, you're getting some return to normalcy. And we know that because on the other side of the equation, tax-free bonds, Munis, rallied this week with 10-year and 30-year bonds down about 15 basis points. What does that mean? That means that those yield ratios, when you talk about the comparison from a tax-free yield to a treasury yield, which we know as of 2 weeks ago were all above 100%, are now down substantially below 100%. That is a little less good news for basically investors. However, stuff that's not AAA out there, you can still get 4%. You can't get 4.5%. So we still think it's a bargain, not the bargain that it was 2 weeks ago. That snapback took away some of the giveaway, if you will. But there's no question we still think there's value out there. Supply is a little muted this week. We think that probably is helpful for the municipal bond market. And we know in front of us, we have the July reinvestment period in a few weeks, and that usually starts a little before July 1st. And June is pretty good reinvestment period as well. So the demand factor, the fact that yields are higher than they were a few months ago, should continue to buoy the market. And the last part is really the fact that this week, for the first time in a long time, you saw municipal bond funds get inflows. And it wasn't great. It was like about $1.2 billion or so. But boy, that's a big change. And we've talked about it before, how you have basically gone from less and less negative outflows to finally a week of positive outflows. We will watch this going forward. We hope everybody has a nice weekend, and we'll see you next week. Thanks.
Thanks, John. Great information. Don't forget to like, comment, and subscribe. Be back with us next week. We'll be back on Friday reviewing what we saw in the trading week and what may affect markets going forward. Enjoy the weekend.